$850 billion. That is not a statistic. That is not a headline. That is not a number buried in a government spreadsheet. That is leverage. And right now, that leverage is pointed directly at the American financial system. For years, anyone who warned about a bond market collapse was dismissed. Conspiracy theorist, alarmist, doom merchant. We were told it could never happen. The U.S. Treasury market was too big, too liquid, too powerful to fail. But today, what was once impossible is quietly becoming inevitable. This is not just economics. This is a geopolitical divorce between the two largest superpowers on Earth. And divorces are expensive, especially when trillions of dollars are involved. For 2 decades, the relationship worked. China manufactured the world's goods: electronics, clothing, furniture, infrastructure components. America consumed them. In exchange, China received dollars. And instead of spending those dollars elsewhere, they recycled them back into U.S. Treasury bonds. They loaned the money back to us. That recycling machine kept American interest rates artificially low. It kept mortgages cheap. It inflated asset prices. It subsidized the American lifestyle. It was the greatest financial arrangement the modern consumer ever benefited from. That arrangement is now over. The trade war cycle has broken the system. Tariffs escalated. Semiconductor access was restricted. Strategic technology was cut off. And in response, China made a rational move. They stopped financing America. Officially, China holds roughly $760 billion in U.S. treasuries, but when you include agency debt tied to entities like Fannie Mae and Freddie Mac, the real number approaches $850 billion. That is not passive ownership. That is strategic leverage, and they are using it. China is selling U.S. assets at the fastest pace since 2015. Not randomly, not accidentally, deliberately. They are converting paper promises into physical gold. 28 consecutive months of gold accumulation, a historic record. Why? Because paper issued by a geopolitical rival carries risk. Gold does not freeze. Gold does not default. Gold does not depend on policy speeches. Now here is where this becomes personal. The U.S. government runs a $2 trillion annual deficit. That means every year it spends $2 trillion more than it collects. To survive, it must constantly issue new bonds. In the past, China was a guaranteed buyer. Now they are not only absent, they are selling. When supply overwhelms demand, price falls. And in the bond market, when price falls, yields rise immediately. That is why mortgage rates are rising even when inflation data cools. The Federal Reserve controls short-term rates. The bond market controls long-term rates. And the bond market does not take orders. If China sells $50 billion in treasuries tomorrow afternoon, your mortgage rate can rise, even if the Fed cuts rates in the morning. That is fiscal dominance, debt size overpowering policy control. The 30-year mortgage follows the 10-year treasury. If that yield pushes towards 6%, mortgages mathematically approach 9%. That is not opinion, that is arithmetic. At 9% mortgage rates, housing affordability collapses. Commercial real estate implodes. Refinancing becomes impossible. Bank balance sheets crack. And banks are already sitting on over $600 billion in unrealized losses. The reverse repo facility, once a $2 trillion shock absorber, is drained. The cushion is gone. Liquidity is thin. Every additional stress point now hits metal, not rubber. This is not theoretical fragility. It is structural vulnerability. At the same time, the petrodollar system, the foundation of global dollar demand for 50 years, is weakening. China is settling oil trades in yuan. Side agreements are forming. BRICS nations are building alternative payment channels. That means less global demand for dollars precisely when America needs buyers the most. It is a pincer movement. From one side, selling bonds. From the other, reducing dollar demand in trade. Meanwhile, interest payments on U.S. debt are compounding. Soon they rival defense spending. Eventually, they crowd out everything. This leaves policymakers with 2 brutal choices: print and inflate, destroying purchasing power, or refuse to print and trigger deflationary collapse. History suggests which path politicians choose. Inflation is a silent tax. It requires no vote. It passes automatically. That is why smart capital is repositioning. Central banks are accumulating gold at levels not seen in half a century. Sovereign wealth funds are acquiring land, energy assets, copper, lithium, hard assets, tangible value. Because when paper confidence cracks, value migrates. The 60-40 portfolio model, stocks and bonds, depended on bonds being the safe side of the equation. That era is over. Bonds are now the epicenter of volatility. When both stocks and bonds fall together, traditional diversification fails, and this is where the average saver becomes exposed. If your wealth exists only as digital entries inside leveraged institutions, you are trusting stability that is no longer guaranteed. If you cannot touch it, you do not fully control it. This does not mean panic. It means awareness. It means strategy. We are witnessing the slow restructuring of a global monetary order built on cheap credit and endless demand for U.S. debt. 40 years of declining interest rates are reversing. Cheap globalization is reversing. The China price era is ending. As that unwinds, asset prices must reprice. Housing, equities, bonds, currencies. But remember this, wealth is not destroyed. It transfers. From leverage to liquid, from passive to prepared, from paper to tangible. The storm is not forecasted. It is already overhead. The question is not whether the system changes. The question is where you stand when it does. Will you hold promises or will you hold assets? Mathematics does not negotiate. Debt compounds. Yields respond. Markets adjust. The red warning lights are flashing. And the final trigger, the one signal that historically forces the Federal Reserve to print again, has just appeared. Understand the structure. Understand the timing. Position accordingly. Because this is not about fear. It is about preparation. The era of easy money is over. The era of disciplined strategy has begun.